In this video, we will talk about creating passive income through real estate investing. So stay tuned. In this video, we will cover what is passive income? Why is real estate so great for passive income? Are there downsides? 16 types of passive income with real estate. Characteristics of a successful investment property. Questions to ask before investing in a passive income property. How can Mashvisor help? Navigate the video using the chapters in the timeline below. What is passive income? Passive income is defined as earnings derived from an investment. It means an investor is not actively involved in an investment's day-to-day function. This means that once you have set up your investment, you can just sit back and collect payments without having to put in a lot of regular effort. Why does everyone talk about passive income? First, it allows one to live off investments without having to actively work for money. And this means you can enjoy your life without being tied down to a job or a single job. Second, passive income can provide a buffer against unexpected financial setbacks. If you have a steady stream of passive income coming in, you will be better able to weather a temporary loss of income from your day job or from an unforeseen circumstance. So why is real estate so great for passive income? First, real estate is relatively stable as an investment. Unlike stocks or other securities, the value of your property is not likely to fluctuate wildly in the short term. This makes it easier to budget for and predict your income from month to month. Second, real estate provides the potential for significant tax breaks. In the United States, you can deduct the cost of your mortgage interest and property taxes from your taxable income. And this can significantly reduce the amount of money you owe in taxes each year. Third, real estate can be a very hands-off investment. Once you've found the right property and put together a good team of tenants and managers, you can largely set it and forget it. This frees up your time to pursue other interests or simply enjoy your life. And fourth, real estate provides the potential for significant appreciation. Over time, your property is likely to increase in value thanks to inflation and market forces. This means that your passive income will likely increase as well, giving you even more financial security. Are there any downsides? The most significant downside to investing in real estate for passive income is the amount of money required to get started. You will need enough money for a down payment as well as money for closing costs and repairs. Another downside is the time needed to find tenants and some people to manage your property for you. If you do not have the time or the ability to do this, you may want to consider hiring a property manager or betting on another type of investment altogether. Lastly, there is always the potential for vacancy. This means that you may not have any tenants for a period of time and will not be generating any income. A quick search online, however, proves passive income is a viable vehicle to financial freedom. CNBC.com published an article on a 23-year-old named Michael Albaum. Albaum owns 61 rental units that generated $431,000 in rental income last year. CNBC goes on to say that he works from a converted van where he and his wife are traveling across the United States. Albaum's story is not just one example of how real estate can create financial freedom, though. Another great example is a guy named Ryan Chaw, who in a Business Insider article noted that he's earning $6,000 a month in passive income from 6 properties at 30 years old. And he plans to acquire 2 more in the near future, as soon he'll close on his 7th, and he's about to put in an offer on an 8th property. Friend to the channel, Robert Kiyosaki, said this about passive income.
It's a paycheck mentality.
A paycheck mentality.
Look at the other side. They say, don't get into debt. I'm in debt up to my eyeballs.
Right.
You know?
Because as a businessman, you want some leverage.
Well, there's good debt and bad debt. See,
Right.
bad debt is debt I have to pay for. So my house, I have to pay for it. So it's bad debt. Mortgage is bad debt. At the same time, I have about $300 million in debt. But it's good debt because my tenants pay it off. My landlord. So I'll say it again. So good debt is debt that somebody else pays off for me.
Right.
And so that was the lesson of Rich Dad, Poor Dad.
So without further ado, let's talk about some passive income ideas that can be generated from real estate. Number 1, traditional rental income from investment properties. Investment properties are one of the most popular sources of passive income. By owning a rental property, you can collect regular rent payments from tenants. And as I said, you can do it without having to do a significant amount of daily work. Airbnb or other types of short-term rental properties. One can generate income by renting out a property or even spare room on Airbnb or a similar short-term rental platform. You can make extra money if you have the space, and it's an up-and-coming business, so it might be great to explore now. Number 3, income from real estate joint ventures. A joint venture is a business arrangement in which 2 or more parties agree to cooperate in order to invest together. In my experience, sometimes one person brings the money to a deal and another is able to renovate or maintain a property. So, if you have someone you could trust, it might be a nice situation. Number 4, real estate crowdfunding. Real estate crowdfunding is a relatively new way to invest in a property without having to go through the traditional process of buying or financing a property. With real estate crowdfunding, you can pool your money with other investors and use it to finance a real estate project. Once the project is completed, you will receive a share of the profits. Real estate investment trusts are companies that own, operate, or finance income-producing real estate. It's a possible way to invest in real estate because they offer the potential for high returns that are relatively low risk to you. Leasing land for cell towers. Leasing land for cell towers is a potentially lucrative way to earn passive income. Cell phone companies will pay you to lease land in which they will build a cell tower on. The term of the lease typically will range from 10 years to 99 years, and the rent may include a percentage of the tower's revenue. Advertising on billboards or other commercial properties. If you own a commercial property, you can generate income by renting out space for advertising. This can be a great way to earn that passive income we've been talking about, as long as you have a high traffic location. Renting out storage units. If you have extra space in your home or office, you can rent it out as a storage space for people who need somewhere to store their belongings. This can be especially lucrative if you live in an urban area where storage space is at a premium. Renting out parking spaces. If you have extra parking spaces, you can rent them out to people who need a place to park their cars. If set up correctly, it may not require a lot of your time, and again, it can be especially lucrative if you live in an urban area where parking is at a premium. RV parks and campgrounds. RV parks and campgrounds are another type of commercial property that can be used to generate this kind of income. If you own an RV park or a campground, you can charge people to use your facilities, nightly, weekly, monthly. Mining royalties. Mining royalties are payments that mining companies make to the owners of the minerals that they mine. These payments can be a great source of passive income, as you just have to own the land and you're set to go. Air rights. Air rights are the rights to use the air above a piece of real estate. If you own a piece of property with valuable air rights, you can lease those rights to a company that want to build a structure or utilize the space above your property for some kind of business reason. You see this done in a lot of rather big cities. Wind leases. Wind leases allow companies to build wind turbines on your property. This works similar to how the cell towers work, as we spoke of earlier. They basically install a unit on your property and they give you a long-term lease in exchange. Solar leases. Solar leases are agreements between a landowner and a company that may want to use your land for solar energy production. Water rights. If you own a piece of property with water rights, you can lease those rights to a company that wants to use the water for business purposes. Think, for example, a farmer who needs to water their crops. Oil and gas leases. Oil and gas leases are agreements between a landowner and a company that want to drill for oil or natural gas on your property. Again, this can be rather lucrative if you're lucky enough to have such things in the ground at your property. So now that you've gotten some ideas of how to make money using passive income as investments, here are some characteristics of successful properties to consider. Does the area you're considering buying into have low crime rates? Does it have high employment rates in the area? What is the percentage of owner-occupied homes? Owner-occupied neighborhoods are notoriously nicer and better kept than renter-occupied only ones. Does the area have a good school district? Does it have favorable local laws that support what you are going to do with the property in question? Of course, Mashvisor does all of this for us, and it has a heat map tool where you can see the viability of an area and compare it with other locations. Think of these things as well. Cash flow. Cash flow is the net amount of money that goes in and goes out of a rental property. It is the difference between the total amount of money collected from rent and other sources and the total amount of money spent on operating expenses. Net operating income, NOI. NOI is a measure of the income generated by a property after operational expenses are deducted. The formula is rental income plus other income minus operating expenses. Cash-on-cash return. If you plan to finance an investment with a mortgage loan, cash-on-cash return is an important indicator to consider. It's the annual pre-tax cash flow, NOI, minus annual mortgage payments, to the overall cash investment ratio, so down payment, closing costs, any rehab expenses, and other charges. These indicators are crucial in real estate property research since they reveal information about a rental property's performance overall. Usually anywhere between 8 to 12% is ideal for cash-on-cash return. Cap rate. Cap rate is the possible rate of return on an investment property if it's bought in cash. It's computed by dividing the property's net operating income, or NOI, by the purchase price, or market value. Because the manner of financing is not considered, it is typically used to compare many similar investment homes for sale in a specific location. Many real estate investors strive for a high cap rate, typically between 7 to 12%. Keep in mind, Mashvisor has an investment property analysis calculator to make calculating and understanding these numbers easier. Spreadsheets are fantastic, I always say it, but they are prone to be glitchy and have mistakes, so Mashvisor makes the whole process easier. Now, let's discuss some questions you should ask yourself before investing in a passive income property. Just because a property will generate passive income doesn't mean it's the right business choice for you. So ask yourself, what are the risks? What is the time commitment to profitability? What are the tax implications of buying the property? Think of the legal implications. How much work will be required to set up and maintain the investment? Are there any environmental concerns? What is the current state of the real estate market that you are currently in? How much debt does a property have against it? Consider if you will need tenants to make your property successful. Where will they come from? Maybe there are renters in the property now. How much are they paying per month? These are things that you'll have to know. How can Mashvisor help you find passive income investments? Mashvisor is a real estate data analytics platform that helps investors find and analyze investment properties. With Mashvisor, you can search for properties by location, by type, and by investment strategy. Once you've found a property that you're interested in, you can use Mashvisor's tools to evaluate its potential for passive income. For example, you can use the investment property calculator to estimate the monthly rental income, cash flow, and ROI for a property. You can also compare properties side by side to see which is the better investment for you. So let's wrap up. For many people, passive income is the key to achieving financial freedom. And according to experts, you should throw anything that you can at it. In fact, some say that you should have 5 or more income streams at once. This is because if one fails, then you have others to help maintain your income strategy. Owning real estate is a goal for many people, and if it is for you, as always, Mashvisor is here to help, and you can get a free 7-day trial by using the link in the description. My name is Michael. Thank you so much for watching, and I'll see you next time.